Well, good morning, everybody. Would like to welcome you to our ongoing series in the trenches addressing various compliance and regulatory concerns in the wake of the COVID-19 pandemic. Those of you who have been participating in these weekly webinars know both me, Brad Rustin, and Craig Nazaro on our financial regulatory team as we have presented these each week. Today, we're really pleased to welcome two of the superstar associates who work on our financial regulatory team, Samer Roshdy and Liz Donaldson. They're going to be presenting mainly today on a topic that has really come to the forefront in the last few weeks. Almost every prudential regulator is beginning to focus on this particular issue. In particular, you're seeing both prudential bank regulators, the CFPB, as well as the FBI and other groups that are all focusing on concerns related to fraud relating to the COVID-19 pandemic and some of the exploitations of individuals, particularly certain targeted groups in the wake. And so what we're going to do today is walk through a little bit about what you can do to combat some of that fraud, how you can identify that fraud, the types of fraud that we're seeing. And so I'm going to turn it over to Liz, who's going to introduce this concept, and we'll go off and get started. So thank you for joining us today.
Good morning, everyone. Thank you for joining us. As Brad mentioned, we've seen a huge uptick in fraud in light of the COVID-19 crisis. These are some reports that were compiled by the Federal Trade Commission as they receive consumer complaints and reports relating to fraud. As you can see, as the pandemic picked up, we saw a huge spike in fraud, and about the middle of April 16th was the height of all of this, with more than 1,600 reports in a single day. We'll talk a little bit more about what these reports are and what the FTC is seeing, but the number of reports, it started to dwindle down. They anticipate seeing a continuing spike as the types of reports shift and change over time.
And as we think about what's happening right now, what type of fraud we're seeing, this is kind of a compilation of some of the most important trends that we're seeing, which is there's many different types of fraud that's occurring. There's specific COVID-19 phishing scams. There's been individuals targeting customer shifts to mobile and other online types of product deployments for financial services. But really what I want you to focus on this slide are some of these numbers to really drive home why this matters so much. And that is just simply looking at Google reports, you see an 18 million additional malware and phishing emails per day are being generated, and almost all of those additional 18 million are referencing something having to do with COVID-19. There's been a 350% increase since March in the number of phishing websites. The Barracuda numbers that are being reported, same thing, 667% increase, almost a seven-fold increase in spear phishing attacks just from February baseline into March, and we've continued to see those numbers hold steady. Similar, FBI is reporting almost a 4 times or a 400% increase in daily reports of cyber attacks and fraud. What we're seeing is across the board, as we shift to a non-face-to-face environment, a technology-driven environment, malicious actors are viewing it as an opportunity to commit fraud. You have a lot of individuals who traditionally were not extremely involved in tech-driven operations, meaning folks who weren't using mobile apps, who weren't using websites traditionally to make payments to lenders, make payments to financial institutions, obtain financial services. All of that is now shifting to a non-face-to-face environment, whether that be mobile or online or other deployment mechanisms. And you have a lot of people who are new to that technology who may not appreciate the fraud risks associated with it. Similarly, you have huge numbers of people who are working from home, working remotely as part of the sheltering in place orders in the different states. And so those are also now rife with fraud because less people are sitting inside of an office in a controlled IT environment and instead are working from home where they may have less secure internet access. They may have fewer security measures in place to avoid potential targeting. What all of this means is we're seeing this huge spike as we are starting to move forward into the second quarter of 2020, and we expect all of these to continue. Let's go to the next slide. Perhaps most troubling is some of the initial reports of the volume of fraud that's out there. This is actually an article from The Hill that quoted a series of senior FBI administrators. And what they're saying is if you look at the number of stimulus checks that were received, almost $30 billion in stimulus funding, they believe will be stolen through various fraud scams. All of our financial institutions have already been reporting huge numbers of individuals that are being targeted. A lot of these people who are receiving these stimulus checks, the way it was deployed, you just simply received suddenly an ACH payment if you were set up for ACH on your tax returns, and you suddenly received these stimulus funds into your bank account. Almost immediately, we saw a wave of potential fraud with people trying to claim that they were reclaiming it because it was wrongfully taken by the government. We'll talk a little bit about all these different scams that are being that are targeting individuals. But anytime you have this number of individuals who are all receiving new funds from a source that's not common, you simply have a circumstance that's rife for fraud. And perhaps most troubling to financial regulators is oftentimes these are targeting vulnerable populations, either those who are underbanked or unbanked, less sophisticated in their knowledge of financial products, or, and we'll talk about this towards the end of the presentation, particularly targeting elderly Americans who similarly may not have a lot of existing sophistication with financial services being delivered in an online or mobile environment. So we'll head on to the next slide.
As Brad mentioned, we've seen a huge influx, and the numbers are pretty troubling. Last week, the FTC released their newest report, which picks up the second half of May and the beginning of June as far as what type of fraud that they're beginning to see. And numbers are staggering. Since they began collecting data on COVID-related fraud, which they began the first week of March, they've seen almost $60 million of COVID-specific related fraud. And we'll talk a little bit later about how that fraud occurs and what some of these scams are. And as you can see, the top areas of the FTC reports are online shopping, travel and vacations, which was a little surprising to me, credit cards, mobile and text messages, and then a category that the FTC calls banks, savings and loans, and credit unions. What we actually have seen in practical experience is that these are all related and interacting fraud scams. A lot of them are payments related. People are trying to buy protective medical equipment, or particularly the higher grade masks that can provide additional protection. And there's either fraudulent products, so that falls into that online shopping category, or there's fraudulent mechanisms for the payment that money is being moved to other areas, and similarly, whether or not the payments are being made via credit card. We've also interestingly seen a huge influx in identity theft related to fraud, that people are, as Brad said, maybe not protecting their identities as often, or fraudsters are conducting more of these phishing attacks that are targeting some vulnerable people who may not have as much internet security as they did before, and is resulting in a big increase in identity theft. And then finally, interestingly, the number of calls that are being made to people who are on the Do Not Call registry has increased significantly, relating to these fraud scams. People trying to do calls to get credit card information or payment information to purchase medical equipment or other protective devices are reaching consumers who historically have been on the Do Not Call registry. So we're going to shift over, and Samer's going to talk to us a little bit about some of the types of fraud that's already occurred.
Thanks, Liz. I'm sure you've all been seeing all these headlines pop up over the last few months, especially with the COVID-specific fraud that's going on. But I wanted to talk about one specific example. As you can see from the bottom American Banker article, in this case, the individual is actually accused of applying for SBA emergency loans, PPP loans for several companies, and that individual actually claimed that he had hundreds of workers on payroll, and that totaled to millions of dollars. So they were seeking lots of funds that and according to prosecutors, he was actually the only one that worked for his alleged company. So just one funny point, but in one of his loan applications, he actually said that the company would help the country reduce the high unemployment rate caused by the pandemic by helping unemployed American workers and unemployed American fresh graduates find jobs as quickly as possible. So some pretty big claims for someone who only has one employee. But apart from allegedly lying about this company, this individual claimed that the companies were involved in procuring PPE and COVID-19 test kits. So all of that, the prosecutors allege, are false. But out of the $20 million in applications, his two companies were actually approved for about $1.45 million in loans before the fraud was discovered. So this individual is now facing charges of defrauding both the U.S. government and the banks that he sought loans from. Can you go to the next slide, please?
Samer, one interesting point to raise on that too is, we've been seeing that the Department of Justice has assembled a task force specifically related to CARES Act investigations, and that's being coordinated at in the various jurisdictions. So, for instance, there could be a Georgia task force that involves U.S. attorneys and other stakeholders within the state. But a lot of these early cases that they're bringing, a lot of their early investigations have been related to these types of PPP fraud cases. But we think that's going to continue to expand as more and more financial institutions are going to be getting either subpoenas or civil investigative demands related to instances of CARES Act fraud. But it's really become a hot button issue right now within the Department of Justice as they try to crack down on some of these things, like we saw, people buying Rolexes and cars with PPP money, or similarly trying to defraud individuals with personal protective equipment. So I think we'll continue to see a significant increase in that as those task forces continue to broaden their investigations, particularly as it relates to the wave of PPP loans, as individuals start filing their forgiveness applications that are much more detailed than their applications for PPP loans. We would expect to then see a series of investigations beginning as those companies begin to put in their certifications and the real details of how they use that money.
So in this slide, we have the categories of the most common scams that the American Bankers Association actually published recently. And they're all scams related to COVID-19, but as you can see here, they range from consumer-facing stimulus check scams all the way to investment-oriented scams, which are targeted at those larger institutions that Brad just mentioned.
I think it's interesting to note that we've seen a big influx in a number of charity scams, and the ABA has noted that, and that people are rightfully concerned about what is going on and the healthcare crisis across the United States, and they generously want help. But unfortunately, the ABA noted that there are significant increase in these scams, and they do target people who are wanting to be generous and trying to help. So just kind of an interesting area of note. As Brad mentioned, we've seen a rise in fraud in light of COVID-19 for a variety of reasons, primarily being that, this is an unknown environment for everybody. There's an unprecedented number of people working from home and accessing their work network remotely with networks that might not be as secure. On the bank side, that can be problematic too. If there are bank employees or financial institution employees who are working remote, we all have very robust, as financial institutions have very robust security procedures in place, and those don't always carry over when employees go to working in a remote environment. Additionally, there are people buying things online that they historically have not been buying online. I think we've all individually started doing a lot more of our shopping online, from grocery store shopping to Amazon, that things that we historically haven't purchased, we've maybe been more willing to share our credit card information than ever before. There's also, as Brad mentioned, a huge influx of people who are interacting with their financial institutions online for the first time. People are downloading mobile and digital banking apps. They're going on to the online banking. A lot of people for the first time and don't necessarily understand the importance of having secure passwords and making sure that they are logging out. Most systems now will automatically log you out, but the security isn't necessarily there for these customers who don't have knowledge of what the best practices are. And as we've already started talking about, fraudsters are taking advantage of the circumstances. And some of the more disturbing ones are situations where people are replicating the emails and communications from the Centers for Disease Control or the World Health Organization. With the stimulus checks, we see an increase in people who are getting fraudulent emails from the United States Treasury, and consumers thinking that the communications are related to their stimulus checks when in fact they are fraudulent. And there's some new challenges. I think this is a very telling thing, is that businesses think they're very good at combating fraud. We have security procedures in place, and that may be true in a normal environment. About a year ago, Experian did a study that found out that 95% of businesses believe that when a customer logs on to their account, that the businesses believe that they are correctly identifying their customers. And the customers don't necessarily feel the same way. When asked the same types of questions, customers responded that they believe only 55% of the time that businesses are properly identifying them when they enter onto a website. Similarly, customers are increasingly digitally savvy, and this is something we talk about all the time, even outside the COVID context, when we talk about online banking and online experiences, that customers want things to be smooth. They're used to that one touch. They're used to it being very quick, and security can sometimes inhibit that great customer experience, and there has to be the correct balance between creating a smooth customer experience and making sure that you have the proper controls around knowing your customer and identifying them properly. So those two things are constantly in conflict. Next up, people who historically have not used online shopping, online banking, and online services, such as elderly people, are using the internet for the first time, and they may not be as security sophisticated or as digitally sophisticated. And Samer's going to talk a little bit more about that and the rise of fraud that we've seen recently. And then finally, these are very uncharted times. We have people buying things that they historically have not bought. We have people doing things that they have not historically done. We're in uncharted waters, and we've altered our behavior as a society in a way that, people may not be as concerned about digital security as they focus on the ongoing health crisis. We're going to shift over now to talk a little bit about the FinCEN guidance that's come out and some of the issues related to suspicious activity reports in light of all of the fraud that is increased due to COVID-19. On May 18th of this year, FinCEN issued a report that identified 3 key areas relating to fraud in light of the COVID-19 pandemic. And we kind of walked through these as they related to financial institutions filing their suspicious activity report. So the big 3 areas that FinCEN has focused on, and we'll dive kind of into what the red flags are related to each of these, are fraud related to cures, tests, vaccines, and services. So this primarily is people who are selling or providing information related to purported vaccines and cures for COVID-19, or companies that are offering to come in and disinfect businesses so people can go back to work, or the big area is really tests, and whether or not the people are authorized to be selling tests or are actually a medical company at all. The second is for non-delivery fraud of medical-related goods. This is probably one of the biggest areas of concern and one of the biggest areas where we've seen a lot of red flags is businesses that are purporting to sell PPE or medical-grade hand sanitizer, masks, again, COVID-19 test kits for antibodies that oftentimes these companies do not possess at all, and they simply disappear after a significant number of consumers or even businesses have purchased the purported medical equipment. And some of the numbers that are associated with that are quite astounding. And we'll dive into, FinCEN has provided us with some case studies that they've done of some of the fraud that's occurred in light of COVID-19. So we'll talk a little bit about those as we walk through some of the red flags. The final group that FinCEN has noted is about price gouging and hoarding of medical-related items. This one has not been as significant of a issue as the first two as far as SAR reporting. But this is the situation where companies accumulate significant numbers of PPE or other medical-related goods, and then, in violation of federal price gouging laws, sell them at high prices. And again, in certain situations, there's activities that also look like hoarding. That the businesses may not actually be hoarding at all, and tying into that second category up above. So let's talk about each of these a little bit in turn. So for the first category that FinCEN has identified, which is the fraud in the selling of cures, tests, vaccines, and services, FinCEN's identified all of the listed red flags related to these, and each situation, obviously, with red flags is different, but when looking at the types of transactions that are occurring, some of these are more common than others. Some of the big ones is the transaction of sale of business services, sale of medical supplies through a personal account. There's been a huge influx in that, and it's a good indication that there's potentially fraud. Additionally, and this I think is becoming somewhat decreasing, but certainly at the beginning of the COVID crisis, when there was a lack of PPE, that businesses that were selling PPE to the consumer market rather than to hospitals was a good indicator that there was potentially fraud. Another situation, this one's pretty hard to determine, is where you've had a shift in the type of transactions that are being conducted. And this is something that we've seen some financial institutions struggle with determining whether or not this is a true red flag, as we've seen businesses shift away from their traditional services towards doing things like making masks. And you may have, for example, a clothing retailer who is no longer able to sell clothing, but they've shifted over to the production of masks, and the dollar number and the volume is different on those versus their traditional clothing that they're selling. So that's kind of been a shift. But the big one for that category that we've seen as a trigger for being a suspicious activity red flag is changing of the payment method, where instead of accepting their traditional payment methods that you'd see for a retailer, such as a credit card or debit card, that there's requirement of using some sort of money transmission or a prepaid card, something that's going to mask the transmission of funds. As I mentioned, for each of these categories, FinCEN's given us some case studies that they've done, and relating to this, the fraudulent cures and tests, FinCEN gave some information that they found that the DOJ has been involved in arresting an individual who was shipping mislabeled drugs from the UK to a residential address in Utah, and he was labeling it as the Trinity COVID-19 SARS pathogenic treatment kits, and in selling those kits, the kits had never been approved by the FDA for the treatment of COVID-19 or any other use. These were just, generic tests, and the FDA and the DOJ began investigating these, and were able to stop a significant amount of the fraud. But that's a good example of some of the things that are happening in this area. The second area that FinCEN has indicated is the issue with non-delivery of fraud of medical-related goods. So this is, again, where the company purports that they're selling masks or hand sanitizer, and they don't have any inventory at all. And so people purchase large volumes, usually businesses will purchase large dollar volumes and never have anything sent to them. The biggest indicators of red flags in this area is the things you'd see with new businesses and are really not COVID specific red flags, that it's a new business that has just recently been started. And the business has a lot of different DBA names, doing business as names. Those are good indicators that this is not a true company. The other one where we've seen a big issue is where the company says that there's been a lot of delay in providing the goods, and that's why the consumer hasn't received them. If there's an ongoing delay, that's a good sign that there's a significant amount of fraud. There was a situation where in the FinCEN case study for this, where a foreign government had actually sent money, millions of dollars, to a fraudulent company that was held an account at a financial institution in Virginia. And the financial institution in Virginia flagged the account because it was over $100 million, and the account had only been opened 5 days ago. And they properly reported it to FinCEN as part of their SAR reporting, and were actually able to stop the fraud. The DOJ was able to get involved, and it resulted in the ultimately $317 million fraud prevention related to the non-delivery of masks. So that was a great win, mostly thanks to some reporting by some banks, particularly one bank in Virginia. Finally, the last area that was emphasized by FinCEN is price gouging and hoarding medical-related items. Again, another good indicator on this one is that a customer is using their personal account for business-related transactions, and that the transactions are focused on these highly sought-after goods, particularly hand sanitizer, toilet paper, and masks. And that's a good indication, especially of the hoarding aspect of it. And then if there's a large influx of transactions related to, and high dollar number transactions that are unusual for the account, that's also a good indicator that there could potentially be price gouging associated with it. The case study for this area is a story about the FBI investigating a man in Brooklyn, New York, who was lying to officials about hoarding surgical masks. He had N95 respirators, which, as we all know, were especially rare at the beginning of the crisis, and he was contacting people via a app called WhatsApp and about purchasing these masks at over 700% above the retail price. So this is a pretty significant increase in pricing. And when people went to pick up the masks, because part of what helped catch this guy is that he required that people could pick up their N95 respirators in person, the warehouse that he was storing them in had enough to outfit an entire hospital in the city of New York, which is, as we all have seen, is a very large volume. These are very large hospitals, and the individuals who are purchasing these masks reported to the FBI that these were this man was hoarding these materials in New York. Since the middle of May, when that last report from FinCEN came out, FinCEN's provided some additional guidance related to COVID-19 related SARs. After the first round of guidance came out, FinCEN started to see a large number of indicators in the SAR reporting that had to do specifically with the issues that financial institutions were having in light of COVID-19. And FinCEN, in their new guidance, has requested that financial institutions instead focus on the specific COVID-19 suspicious activity that they are reporting, rather than the issue that the financial institution is having. So there's they are encouraging banks and other financial institutions that when there is suspicious activity that they related to any of the things that we have just discussed, that they add the key term COVID-19 FIN 2020 A002 into SAR Field 2, and to make sure that when they're using that coding, to focus that coding only on situations where it is COVID-related fraud and does not have to do with COVID-related issues relating to the financial institution's SAR reporting. So focusing on what is the type of fraud and whether or not that fraud is related to COVID-19. And then FinCEN has also emphasized that financial institutions should indicate the type of fraud and the name of the type of the scam or the products or what we have just talked about. So product fraud, non-delivery scam as an example, or price gouging as one of those within the SAR field, so that that FinCEN can specifically identify the type of activity. Because as we'll talk about in a little bit, there's a lot of different government entities that are working together to combat some of this fraud, and that FinCEN's trying to make sure that things are being sent to the correct federal agency or federal or state agency. Additionally, FinCEN's reminded financial institutions that when they file a SAR, that they have to make sure that they're maintaining copies of that SAR for 5 years, consistent with their record-keeping policies, and that it's important, particularly now due to the diverse number of law enforcement agencies who are involved in combating some of this COVID-19 related fraud, that the financial institutions cooperate and that they share those SARs. And FinCEN just sent a reminder that the financial institutions that share their SARs with law enforcement are protected under the safe harbor provisions on reporting to law enforcement agencies.
Great point there, Liz. We've seen a lot of that in the last few weeks as different local agencies are trying to assist in responding to this. So we've had a lot of our banks, credit unions, and lenders calling in and asking those questions about how do we work with local law enforcement. And remember, the obligation doesn't simply end with the filing of the suspicious activity report. It actually continues. A few cautions there. One, certain information that is filed within a SAR, law enforcement has access to the FinCEN databases. They can go on and pull those directly. They may then contact you about additional information relating to it. And so generally they will have a right to that information, but you do have to be somewhat careful because of protections in GLBA as well as the Right to Financial Privacy Act, or RFP. Usually the law enforcement agencies, unless they are in a particularly kind of rural area that's not typically dealing with a lot of significant financial crimes, will have a good working understanding of that. One thing we are cautioning our financial institutions about is make sure that as you're working with a particular investigator, detective, officer, etc., that you're reminding him and her about the nature of suspicious activity reports. We've seen that happening more and more as people are aggressively trying to shut down these fraud cases, where we've actually seen some instances of police officers or investigators, detectives, district attorneys attempting to file copies of SARs with the court, or actually using the SAR itself as a basis for a indictment or a charging request. It's always just good hygiene to remind him or her that these are highly confidential. You generally can't confirm the existence or denial of the existence of a SAR to any third party other than these particular protections that you're given in working with law enforcement and the Financial Crimes Enforcement Network. But that said, make sure that's something you're bringing to the investigator's attention as you're working with him or her, because we've seen some people slip up on that. Thanks, Liz.
Brad, one thing I would add there too is if it might be a good time, just with the increase in fraud and activity that we're seeing, to take time to examine if you don't have a subpoena group within your institution or your entity, to kind of think through what your subpoena policy is and what the procedures are, so it's disseminated before you're actually faced with law enforcement coming in and asking for records or inquiring about protected transactions and privacy of your borrowers.
Yeah, great point. Good time to do some just general health checks inside of your institution. Make sure you've got good, clear policies on all of this. Fraud triggers for investigating fraud, as well as a good time to just generally update your suspicious activity report and flagging policy to make sure it's fully up to date with all the latest guidance, and that your various policies and procedures have included these updated guidance documents that Samer and Liz have referenced from FinCEN. We're going to be doing another program on preparing for your first post-COVID exam, and that'll be one of our top topics, as we expect the regulators to be looking specifically about whether or not you did adapt your various policies, procedures, and guidance to individuals in your institution to take into account a very, very rapid increase in the number of guidance documents that were being issued by the various regulators. So it's a good time now to start preparing that so you're not crushed with that in the month before your first exam. Great point, Greg.
Yeah, and I think to Brad's point, about making sure that you're communicating with the investigators, and some of them may not be as familiar with the SAR reporting guidelines. As you can see from this slide, this is just some of the federal entities that are involved in investigating and resolving COVID-19 related fraud crimes. And some of these are new groups who may have members who historically have not worked directly with financial institutions. And so they may be very unfamiliar with what the SAR what the SAR process looks like, and what type of information is contained within the SAR. And additionally, you may, as a financial institution, be working with entities that you've never worked with before, both on the state and federal level, just due to the diversity of agencies that are trying to investigate and resolve COVID-19 related fraud. Often you'll be working with more than one at any given time. As you can see, just for COVID-19 related fraud schemes, we've got 3 different federal agencies that are looking at that, and that's not to say that both the Federal Trade Commission and your prudential regulators and different state agencies are also looking at the same issues. So it's become a very large patchwork of some new people who are involved in the process that may never have been involved before, and a large number of them. We're going to shift over now, and Samer's going to talk a little bit about some of our more vulnerable populations and some of the fraud risks associated with elder financial exploitation and abuse.
Thanks, Liz. So yeah, as everyone's mentioned a little bit ago, elders are the most or the largest targets for financial scams, and the reasons for that are relatively simple and straightforward. Elders generally are more likely to have accumulated money and belongings, which seems like a logical argument for fraudsters, right? But besides that, the older adults are more likely to have more equity in their homes. They have regular sources of incomes. And as we touched upon a little bit ago, they are more susceptible to tech-related scams. According to this one FTC and FBI study that was published in late last year, cyber crimes against older adults are actually costing about $650 million in losses per year. And one caveat to that is that these are just the self-reported crimes. So the real numbers are likely much higher. But as we're seeing with the increased digitalization and everyone going remotely now with this pandemic, I mean, this number can only be expected to increase. So it's a little bit of a scary figure, but with the right protocols, hopefully banks can step in and minimize this. But looking at the data, according to FinCEN, these are the SARS filings specifically related to elder financial exploitation. And as you can see here, there's an increasing trend as we progress through time with banks and MSBs, which are most money services businesses. They are filing the most SARS out of all the entities listed. One large reason for this upwards trend is likely due to the increasing focus on digitalization and the way in which we're all obtaining financial services over the past few years. But one interesting point that I noticed here was when you compare these two charts, with the estimates that the FTC and the FBI are putting out there. There's hundreds of millions of dollars that are not being caught through SARS filings. So you're comparing the $650 million estimate of yearly losses with about a $5 million in value of SARS filings. There's about a $645 million gap out there. So there's definitely a lot more going on here than what the SARS filings are showing. Next slide, please. So recognizing that this is a large issue, especially with everything that's going on right now, the CFPB came out with some guidance this week, and they issued a collection of resources which are dedicated to fraud prevention for stakeholders, and these are some resources that your bank can share with consumers. The first four are consumer-facing resources, so they are more topical to your customers, but the last one is actually an advisory and recommendations for financial institutions on ways to prevent and respond to EFEs, which are elder financial exploitation. But that advisory and recommendations does have a lot of good resources within it, and we'll examine these a little bit in the next slide. So with this next slide, we took out some of the points, the major points of the advisory and recommendations booklet, and it's important to note here that the publication is actually one that was put out there in late last year in 2019, but given the vitalness today of this resource, the CFPB republished it to us and put it out there again, just because of the increase in fraud that we're seeing in the market right now. Next slide. So some things to note about this guidance. It included a number of recommendations and specific instructions on how to report EFE to the authorities, to the relevant authorities. It also includes helpful information, which includes descriptions of reporting requirements in the various states. It actually attaches an appendix that banks and institutions can pull up for easy reference. The report also adds details regarding state laws which authorize delays in disbursing funds. The booklet serves as a reminder to institutions of the federal Senior Sofe Act, which was legislation that was enacted 2 years ago. But that legislation encourages the reporting of elder financial exploitation and actually provides immunity in some very specific situations. But that immunity is relevant at both the institution and the individual level. So it's very important that banks keep this in mind as they're developing their training programs. But in addition to that, the booklet reiterates the duty to file SARS when the institution suspects EFE, as we've discussed a little bit ago. And it generally recommends an expedited process when dealing with adult protective services, law enforcement, and other governmental and regulatory agencies. Next slide. So looking a little bit closer at the federal Senior Sofe Act, which the CFPB used to remind institutions of the duties in that act, you need to follow the recommendations by the CFPB in order to avail yourself of the immunity. The big key to this immunity is implementing an appropriate reporting and training protocols. From my understanding from the CFPB guidelines, it seems like this is the most crucial aspect of it, implementing a robust training program which addresses, according to the CFPB, 3 main points. But the first point is it must instruct any individual attending the training on how to identify and report the suspected exploitation of a senior citizen internally and as appropriate to government officials or law enforcement authorities, including common signs that indicate the financial exploitation of a senior citizen. It must also discuss the need to protect the privacy and respect the integrity of each individual customer of the covered financial institution, and the training must be appropriate to the job responsibilities of the individual attending the training.
Samer, if I could add one thing to that. When the CFPB puts out guidance like this, they may not specifically state it, but within 6 to 12 months, you'll see it as a priority of the EICs from the CFPB when they're on site in your banks and your institutions. They'll be looking specifically for elements that are written right in front of you in the guidance. So it'd be very advantageous to just go through your training program, make sure that you're adhering to the guidance. Specifically, if you haven't seen this as a problem, if you have, definitely make sure it's in there. But if you haven't, just do it to anticipate activity from the EIC's teams when they're on site.
That's a good point, Craig. With the CFPB's guidance, they actually added about 7 total points of what a training program should include. On the left-hand side, you'll see that they listed these 3 points as the recommended practices, and on the right-hand side, they actually wrote that these training elements were required and comprise a minimum foundation in EFE training. So I thought that was pretty interesting to note. I mean, ideally, you'd want to have all 7, but the CFPB somehow made a distinction between these 7 points, and that you should, at a very minimum, have the 4 points there on your left, on your right. Sorry. With this next slide, we pulled together the risk indicators that were published in that CFPB report. They actually split them up based on whether the risk indicator is an interaction with an older customer, a caregiver, and other third party, or whether it was due to some account activity which is more recognizable on the back end. But we won't go into all of these examples, but just wanted to highlight these for you all as you develop your training programs. Next slide. And finally, with respect to elder financial exploitation, don't forget these main considerations. It's important to note that this act, the Senior Sofe Act, it doesn't mandate that you report, that you have reporting requirements or training requirements, but it does add a safe harbor that is contingent on the institution having provided the training to the employees. But I mean, as we've discussed a little bit ago, you're already required to report under other regulatory requirements, which may not be the Senior Sofe Act. So as you're developing these reporting and training requirements, which you're required to do, it definitely helps to follow the Senior Sofe Act in order to establish that immunity in any defense in the future. But
yeah, and what we've seen too is a lot of states also starting to mirror that, either previously or in the wake of the Senior Sofe Act, where it's giving you state level immunity as well. And almost every state has some version of an elder abuse statute that grants you immunity in certain conditions. And you know, the caveat to that and caution there is make sure you're exactly following it, because in a number of those states, there are actually penalty provisions that you lose the state level immunity if you don't exactly follow the requirements that are in the statute or the regime.
Yeah, and another point related to that is you want to be cognizant of the fair lending issues that might come up as you're developing these controls. You're dealing with a specific group of people who, under fair lending laws, you're not allowed to discriminate against, because the fair lending laws are written pretty broadly. They state that you can't discriminate based on age and any aspect of a credit transaction. So that's a very broad requirement. So as you're developing these training programs, you definitely want to be cognizant not to run afoul of these fair lending rules.
Yeah, and a point Craig keeps making, I think is one to remember, is even outside of the fair lending context, the ECOA issues, we've seen increased activity, particularly from the Bureau, CFPB, where they're using UDAP concepts in order to pull in fair lending and discrimination claims, even in non-loan products. So it might be a depository product, an account product, other types of services, and using a unfair, deceptive, and abusive acts and practices standard, UDAP standard. The Bureau and other regulators and the FTC have started to go in and say things that would be a violation if this was a lending product under ECOA can potentially be brought in as a UDAP claim.
Yeah, and you also want to keep your GLBA and Reg P privacy-related duties in mind, which Brad mentioned a little bit ago. There are certain exemptions which permit the disclosures, and exemptions are generally available to comply with laws, rules, and legal requirements to protect against or prevent actual or potential fraud, unauthorized transactions, claims, or other liability, and finally, to comply with properly authorized civil, criminal, or regulatory subpoena, or to respond to the judicial process. So these are some exemptions to keep note of as you're developing your program. Next slide. So the next topic that we want to touch upon is related to the PPP fraud that's going on right now. With such large amounts of funds available and the government guarantee and forgiveness that's behind it, and with the ever-increasing new and complex rules that are being developed on a seemingly weekly basis, this is all basically amounting to a fraudster's dream. And in this slide, we put in some PPP fraud indicators. These are the major fraud schemes that we've seen with this program. We won't go into all of these, but it's important to learn from these schemes that you should be on the lookout for similar schemes as they develop when you move into the forgiveness process. Next slide.
And finally, we're going to talk about some of the things that you can do to combat some of the fraud that we've seen arising in light of COVID-19. Education of your customers is key. There's different ways that you can do it. We've seen some really clever ones, especially since traditional outreach in the branches is not possible in all places right now, and it certainly wasn't at the height of the crisis. So we've got an example here on the right side of the screen that shows an email that went out that we thought was a pretty nice way of showing some of the issues that were flagged, particularly by the American Bankers Association. We've seen some banks and financial institutions do pop-ups within online mobile banking. And then we've also seen a rise in the increased use of social media to reach out. And there's some very clever ways that financial institutions have done that to make sure that they're really gripping and get people to pay attention. There's been some great video content out there that can be both fun and informative and is a good way to engage your customers. And then, of course, identifying the areas of fraud that you see, particularly in your financial institution, is going to be key. And then as you move forward, documenting when you see fraud and moving towards remediation. That's going to be the most critical thing, is that when fraud is identified, that it's both documented and remediated, and that all of the controls are then tweaked around that. And as we'll talk about in our later in the trenches series, and we talked about preparing for your exams, when the regulators come in, it's going to be something that they're going to be looking for, that your financial institution has absorbed some of this regulatory guidance relating to specific fraud scams and are responding to them appropriately. Related to that is also doing employee training, working with your employees to both adjust their security standards so that if they are working in a remote environment, that they are meeting all of the security obligations of the bank from a data security standpoint, but also that they can identify some of the fraud issues, or as Samer talked about, specifically some of the elder abuse related fraud schemes that are out there, so that they can work to prevent those or identify them when they happen. One area that we've seen people really expand their fraud prevention programs in light of COVID-19 is using technology. Of course, financial institutions use technology to comply with BSA/AML, making sure that your technology is finely tuned, but there are some other technology resources out there that can be helpful to flag some of these more COVID-19 specific issues that may come up, just because some of the red flags associated with them aren't your traditional red flags that you would see in other financial fraud transactions. If you are using your standard fraud prevention technology, you want to make sure that that technology is picking up these new areas and new red flags that have been indicated by FinCEN. There's also concerns, if you're starting to open accounts remotely related to fraud. Interestingly, in the United Kingdom, the Financial Conduct Authority has issued guidance that's encouraging financial institutions that it has jurisdiction over to have their customers take selfies as part of the customer onboarding and KYC process. They think that that's going to be an opportunity for those financial institutions to mitigate some of the fraud risks with opening accounts electronically. We have not had similar guidance here in the United States, but I thought that was an interesting use of technology as a way to combat fraud. And we'll see whether or not they actually find that they can verify identity through selfies, or if there are other ways that fraudsters can kind of trick that type of software. It's also important not to forget about your current technology that you've got in place, and that you're making sure that employees are still using your typical data security standards, even though they're remote, or encouraging the customers to use that technology. So things like positive pay. This is a great time to market those fraud prevention techniques that you as a financial institution already have available for customers to use to help mitigate fraud. All right, and with that, we're going to open it up for questions. We're happy to figure out.
Yeah, there's a question portal inside of the webinar here. If you do have questions about how you are approaching fraud and customer, either internal training or how you're educating your customers about potential fraud, feel free to send those in by simply sending that question through the GoToWebinar app in particular. A few questions we do regularly get. All of these training materials are available publicly. You'll be receiving a copy of the slide deck if you could find some value in it, using it for training internally, or if you would like it for future reference, as well as the webinar itself will be recorded and available at our In the Trenches YouTube channel and the firm's website, along with the other dozens of materials that we've generated that relate to the financial services industry. That being said, a few key takeaways I think that we'd leave you with as we close out our hour together today is what we have seen is in the same way that COVID-19, some have theorized, accelerated the digitization of financial services 5 to 10 years. We're seeing the same occur with fraud, meaning as we are becoming less face-to-face, we are encountering new things that we have not experienced previously. Interactions with governmental agencies, interactions with each other in ways that we have not traditionally, there really is a lot of opportunity for fraud to develop. And so as you're thinking about the next few months, not only how to assist your customers, individuals within your space with trying to combat this fraud, but also how you're going to be monitoring it within your institution. This is the time to be acting. You don't want to wait until you have an issue either internally or with a large number of your customers being impacted by fraud. And so instead, now is the time to be acting and being really proactive. This kind of leads into our presentation next Thursday on preparing for your first COVID-19 regulatory examination. But this really is that concept of make sure you're staying up to date, make sure that your compliance system it is adapting to changing times, adapting to new challenges faced. And at the end of the day, just like everyone who is out working through helping customers in this COVID-19 crisis, in the same way you can use these types of tips, these structures, knowing the types of fraud and responding to it to really make a difference in customers' lives. So, obviously training, education, and then acting responsibly to it is key. Any other thoughts from our panelists before we sign off today? All right, well, thank you everybody for joining us. That'll conclude our presentation today. If you'd like copies of anything we have presented, obviously feel free to grab that from the website. We'll be emailing it out. Otherwise, we'll plan to talk to you next Thursday as we continue specifically focusing on regulated financial institutions planning for their first exam post-COVID. With that, we'll sign off. Thanks everybody for joining us today.
Thanks, Brad.